Hello and welcome. I'm James Wrigley. Welcome back to another Lunchtime Live. It's Friday, just on 1 o'clock here in Melbourne. Thank you for joining me. Anyone that might be out there, just let me get this up on my own LinkedIn to make sure it's coming through okay. But I am live across LinkedIn, Facebook, and YouTube. As I've said many times before, if you've caught any of these LinkedIn Lives, if you could do me a massive favor and give me a follow on one of those other platforms, that would be really, really appreciated. I haven't been keeping up to the weekly schedule of these. It seems to be every second Friday that I've been jumping on live. So here I am today, and often I'm jumping on at about 12:30, but again, I'm a little bit late. So bear with me. I've just had lunch on my end. Hello to anyone that's out there, and thank you for joining me, Mina. I can see you're there. Thank you. It looks like there's a few others that have joined onto the live stream as well. So thank you, everyone, for joining in. Beautiful day down here in Melbourne. As I was eating my lunch, I just caught the news. The Premier of South Australia is already starting to relax some of the pretty harsh restrictions that they've had in place over there. So to any of my colleagues or anyone that might be watching this in South Australia, certainly looks like good news and a little bit more freedoms for you heading into the weekend. Today's show, or today's live stream, I just wanted to go through a few conversations that I've had with a number of different people in the last couple of weeks. Similar conversations around offset accounts, redraw, insurance, those kind of things. So, as per the title, Habib, hello, thank you for joining me. Also, as per the title or the description, there's three things that I want to get through this afternoon. And if anyone's got any questions or anyone wants to throw anything at me, by all means do so. There's the chat box there. Mina and Habib have already jumped in to say hello. So if you're there, let me know you're there. Let me know where you're watching from. Let's try and make this a little bit interactive if we can. So the three things that I just wanted to go through, as I said, similar conversations I've had with a range of different people in the last few weeks. Offset versus redraw, just understanding the differences there and the planning opportunities, making the most of your offset account if you do have one on your mortgage, and then reducing the cost of your insurance. So I've had a number of conversations around that topic as well. So they're the three pieces. I hope you can join me. We'll go for, I don't know, maybe 15 minutes or so. And if, as I said, if anyone's got any questions or comments, jump in. More than happy to take those on the fly. So first off, offset account versus redraw. So this is for people that have a mortgage, whether that's on their own home, whether it's on an investment property, but offset account and redraw. And I think it's important that you understand the differences, what they are. They're both intended to reduce the interest cost of your mortgage. But redraw is where a number of the banks allow you to, if you've made extra repayments over and above your minimum home loan requirements, the banks allow you to redraw that money, as the name suggests, redraw that money back out to go and spend and do whatever it is that you want to do with that money. Versus an offset account is a separate bank account. So you have your loan over here, you have a separate bank account that's attached, that the dollars that's sitting in that bank account is offsetting your interest bill on the loan. So what the bank does, generally they do it on a daily basis. They say, you owe us $500,000, but you've got $50,000 sitting in offset. So really the difference is $450. We'll calculate the interest owing on the $450 and then charge you that monthly is typically the way that it goes. Whereas if you had that $50,000 sitting in the loan, well, you only owe $450. They calculate the interest exactly the same way. There is a big difference though between what's your money and what's the bank's money. So understanding this is really important. One of the banks, ME Bank, I think it was around Christmas last year, made some changes and caught a few people off guard. It was in the papers, big fuss about it and all got reversed, but you need to be mindful. So redraw is where you've paid extra money into the loan, so over and above your minimum repayments, as I said. The thing you need to remember is that's no longer your money. So you have a commitment to repay the loan back to the bank. You can pay that back as quickly as you like, as slowly as you like, but you have a commitment to pay that loan back to the bank. And if you've paid extra into your loan, it might be sitting there in that redraw facility, but that's no longer your money. That is the bank's money. Technically, that's the bank's money. Now, they give you access to it through redraw, but as ME Bank did around the end of last year, they went and changed things, and they removed people's ability to access that redraw account. So they took. I've got something in my eye. Sorry. That money that you might have had the $50,000 sitting there in redraw. That's technically you've handed that over to the bank to repay the loan. The bank said, "Thank you very much. We'll take that to pay off the principal," and removed access to that money. So that money is no longer yours technically once you hand that over and put that into the loan into redraw. So you need to be careful there. The banks can. There's a whole lot of fuss around it if they do, but they can take that money to use to pay off the loan, and you no longer can access it. Versus money that's sitting in an offset account, that's yours. That's just money that's sitting in a bank account. One of the terms and conditions is that it's attached to your loan and it is offsetting your interest bill, so it works well for you, but that's your money. And so that $50,000 that's sitting there, you can go and spend it, do whatever you like. That's your money. The bank's not going to be able to take that off you. The next thing is if we're looking with a planning mindset and looking forward, is around the strategy that a lot of people look to do, and particularly first home buyers. A lot of people have this aspiration to say, I'm going to buy this first home, we'll live here for a number of years, and ideally try and turn that into an investment property, and then we'll upgrade our family home later, but keep our first home. If you're putting over and above your minimum repayments into your home loan, it goes into redraw, you're paying down that loan. You then maybe try to use some of that money that you've repaid to put towards a deposit on buying another house and converting your current home to an investment property. You can't claim all of the tax deductions for that debt. So you've shrunk your debt, you draw it back out again. You can't claim tax deductions for all of that. So it's less tax effective for you when you pull that money out to go and buy the new house. Versus if instead you'd just been using your offset account, so building up your offset account, that's the one that's slowly going up next to your loan. You take money out of your offset account to go and pay the deposit or whatever it is towards buying the new house. Your existing property, that whole debt that remains outstanding is still tax deductible. So you can trip up if you go down the track of putting money into, piling money into the redraw facility. It's not as tax effective for you if you're trying to do the upgrade. If you're going to sell your house to do the upgrade, it doesn't really matter. But if you're trying to keep your existing property and buy another one, it's not that tax effective for you. So for most people, I suggest to them, just use the offset account. It's your money. The bank's not going to be able to take it from you. And if at some point you decide that you want to keep this house as an investment property and move on, you can just move your money from the offset account and get all the deductions associated with the loan. So if we're saying using the offset account is the way to go, you really need to be looking at making the most of the offset account. And so how do you go about doing that? So making the most of the offset account is really about having as much money for as long as possible sitting in that account. So you need to start to think of that offset account as almost the hub of your financial life. So rather than, as some people do, they'll put $40,000 or $50,000 of savings over to the side in their offset account, and then just transact somewhere else in some other bank accounts, and they live through some different bank accounts. The better way to do that, as I said, is to try and have as much money as possible for as long as possible sitting in that offset account. The best way to do that is to have that offset account as being the hub of your financial life. So every dollar that you earn is going into that offset account. So your pay, your partner's pay, if you get a bonus, you get some inheritance, you sell some investments, whatever it is, have all of that money going into your offset account. Now, most people struggle to manage their cash flow if they've got every single dollar going into an offset account and then they're trying to live out of that same bank account. So that doesn't work. If you have every dollar going in, then you need to set up some separate bank accounts over here on the side that you're actually using for your spending. So your day-to-day spending, maybe you're putting some money away for a holiday or a new car or something like that. So you need to be setting up separate accounts on the side here. These are the ones that you actually use, you transact with on a daily basis. But over here on the left, you've got the bulk of your money sitting in the offset account. So every dollar's going into this offset account over here. You have a transfer going out to the spending accounts, ideally on a weekly basis, and then you spend from there. So you're not messing all of your day-to-day transactions into that offset account. It gets far too complicated. You have some spending accounts over here, but that way you're really making the most of the offset account. You're having as much money for as long as possible sitting in there, which just speeds up the rate at which you can pay off the loan. You're saving interest, all of those kind of things. So redraw versus offset account, please understand the difference there. They are very different. One is your money, one is not your money. And if you are going to use the offset account, you really want to use that to the best of its abilities, your abilities, and have that as the hub of your financial life, and then just have small amounts going out for spending and the like. The last topic that I just wanted to cover is around insurances. So a couple of conversations with people in the last couple of weeks, all of which are probably around mid-40s and onwards, where the cost of their life insurance and their disability insurance, those kind of things, particularly starting to become more and more expensive. So as far as an insurance company is concerned, over the age of maybe 45 or thereabouts, you're starting to become a bit riskier in terms of their ability to insure you. So as you get older, they typically look to charge you more and more for your insurance. At the same time, most insurance policies have this built-in feature where every year they insure you for more money. So you've got, on one side, you're becoming older, so it becomes more expensive. On the other side, the insurance company is increasing the amount of insurance that they have, that they're covering you for, and together, both is really making the policy become that much more expensive over time. Now, for most people through their 30s and 40s, it's often a period of time where their life is upgrading. Things are getting more. Maybe they're getting married or have a partner, potentially having kids, buying a house and a mortgage, those kind of things. So people's responsibilities often through their 30s and 40s start to increase significantly. And so does the need through that time for people to hold often more and more levels of insurance. If you're doing this upgrade that I was talking about earlier, you've got a bigger mortgage, you probably need more life insurance. But for most people, as they move through their later 40s and through their 50s, it's more of a consolidation period of time in their lives. And ideally, through that time, you're building up more investment assets. So whether that's you're paying off your mortgage and so you don't have quite so much debt, your super balance is going up. Maybe you're investing in the share market, you've got an investment property, whatever it is. But through that time, hopefully on the one side, your asset position is increasing and increasing and increasing. And so your need for insurance through that period actually starts to become less and less. Now, remember, for most people, the insurance is there to cover the gap between where they are now and where they actually need to be, should they not be able to work anymore, should they die and they leave some people behind. So it's where are you now versus where you need to be, and that insurance is there to plug the gap. But as your assets are increasing, paying down debts, super balance going up, those kind of things, your need for insurance will generally start to become less and less over time. So you need to be proactive in there. Whilst the insurance company may very well be ramping up the amount of insurance that you have, as you get older, ideally, you probably need less and less of it. So rather than have the insurance company pushing up the amount of insurance that you've got and the cost associated with it, you should actually be every few years going back and just knocking that down, knocking it down. So doing some analysis to say, well, where do I need to get to? How much insurance do I need? In the last few years, I've paid down my home loan by X amount. My super balance has gone up by Y, and my investment property is worth a little bit more, whatever the situation might be. And so you need less and less. And so that as you're actually going through your 50s in particular, where insurance starts to become frightfully expensive for a lot of people, you're actually going about reducing that amount of insurance so that you don't actually see the increases quite so much. You're insured for less, it costs you less, saves you money in the end. So hopefully that explanation was useful. Hopefully I explained that in a way that made sense to you. Mina, I can see that you've got a question here. What would you recommend as a minimum for an offset account? For me, I guess if you're following that strategy that the offset account is the hub of your financial life, there is no minimum. If you have a mortgage, there is no point you having money sitting in a bank account or a term deposit or wherever else it might be anywhere other than in an offset account. Taking what I was saying before, that if you have this offset account acting as the hub of your financial life, every single dollar, what you earn, what your partner might earn, what you might have, just sitting there, rainy day money, all of that stuff, have all of that sitting in the offset account. And then because it is often, we as humans, we struggle to understand, hey, there's $50,000 sitting in that bank account. Most of us struggle to limit the rate at which we spend money. If there's a lot of it sitting in a bank account, it's too hard for us to comprehend. So the better strategy is to say, have that offset account as the hub, and then on a weekly basis, transfer out a certain amount of money that you need for your groceries and your petrol and eating out or buying some takeaway or whatever it is that you might spend, just those incidentals that everyone spends every week. So whether that's $400, $500, $600, $1,000, it depends whatever your lifestyle looks like. But have that small amount of money going out to a separate bank account. That's where you spend from. You're not doing any spending other than paying bills and things from your main offset account. But I guess, Mina, to answer your question, no minimum. I would say if you had $1 sitting in a different bank account that you weren't actually intending to spend very quickly, if you had $1 sitting in another bank account, you shouldn't. You should have it all sitting in that offset account, working as best it can for you. The other bit that some people don't pick up on, and Mina, you may very well understand this already. Pleasure, Mina. Thanks for asking the question. It's great. It makes this a little bit more interactive. The other piece that some people don't pick up on until I point it out to them is that if you have a home, you have a mortgage, you're paying interest on that mortgage. You have interest on that mortgage that you're paying, but on the other hand, you put money in a bank account that's earning you interest. Whilst you're working, you're earning an income. You're also having to pay tax on that interest. So interest rates on your bank account or term deposit are horribly low right now anyway. But even still, you earn 0.5% on your term deposit. Then you have to pay tax on that, and so you've got even less left over. So I guess to your question, Mina, it doesn't make any sense for most people to have any money. If you've got a mortgage, it doesn't make any sense to have any cash sitting in a term deposit or anywhere else other than in an offset account, trying to reduce that mortgage that you've got there. Habib, thanks for your comment. Hopefully that explanation was useful. As I said, I had that same conversation with a couple of people in the last few weeks, so I thought I would share that with the few of you that are tuning in. And Greg, great to have you with us also. Listening in from Victoria, as am I, and Habib is in Victoria, Mina's in New South Wales. So that's everything that I wanted to go through today. Hopefully that's been useful to you. Thank you for those of you that have interacted and put some comments in there. It is great to know that it's not just me sitting in a room talking to a computer screen all on my own. So I hope you have a great weekend. For those of you in Melbourne, it's beautiful weather out there. Get out and enjoy it. I'm off to the local swimming pool with the kids. It's finally open. Yes, I love the outdoor swimming pool. So I'll be off for a swim with the kids. Enjoy your weekend, and I'll see you online next week. Thanks. Bye.